Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So normally we talk about companies that have increased their revenue year after year, companies that have increased their EPS or earnings per share every single year. And the reason we talk about this is because it's genuinely one of the most important thing about a company. And think about this. If the company is not making more sales every single year, how are they going to grow? And it's very important for us as investors to understand this. And this is why I've always said to brothers and sisters who are trying to buy stocks on the stock market and so on, how much are these companies, what is their sales like, and how much is that increasing year after year? Some people are investing in companies that have got no sales. Like they have some sales, but they're actually losing money. They're not actually, EPS is not growing every single year. Revenue is not growing every single year. And I get it. Sometimes those companies could be what we like growth companies, what we like to call, growth companies. And growth companies are absolutely wonderful. But at the same time, they are very, very risky because investors are just betting on the fact that this company will generate basically positive revenue and positive EPS. What I would like to share with you guys today is companies that have increased their revenue and their EPS and revenue 15% or more every single year for the last 5 years. So every single, basically on average for the last 5 years, these companies have been increasing their revenue and EPS 15%. And 15% is a lot. 15%. If a company is increasing that basically on average every single year for basically every single 5 years, that's absolutely amazing. That's genuinely amazing. And not only that, these companies are also are expected to grow their revenue quite a bit in the next coming years as well. So in a nutshell, these are high quality companies, but we also just need to look at other things as well, because the revenue can grow and EPS can grow, but also what other company could be using a lot of that money and wasting it and so on. We also need to look at things like return on equity, return on invested capitals, and all of these things that we always look for, as well as of course how much of that money of the revenue is left at the end, how much of the sales is becoming a free cash flow, because that's important to us. So I'm going to share with you guys 7 companies that have met this criteria, and of course moving forward inshallah is for you to go away then do a bit more research. Just to let you know, I'm not a financial advisor, and some of these companies can be overvalued at this point in time. I'll give you the information. What you do with it is entirely up to you. Just before I start with this one, if you have not sent me your portfolio, please do so. I've started this thing where brothers and sisters can join in the Patreon account and then get a copy of this spreadsheet where you can put all your details. Give me as much details as you can in terms of your background, because it's really important for me to see where you are, basically what is your plan, where you are right now, what are you doing, and then just show me your portfolio. And then what I'm going to do is I'm going to give you a comment about each individual and then the entire portfolio. might even ask you some questions, because I did 3 yesterday, and where some of the brothers have a really great descriptions about what they're doing and so on, and where they are right now in their lifestyle and so on. And then when I look at the portfolio, it really didn't make sense. I'll give you an example. For example, sometimes people have a portfolio, so at the age of say 25, their entire portfolio is high yielding dividend paying companies. There's nothing wrong with that. But at the age of 25, you shouldn't be worried too much about that income. Right now I'm getting closer to 40. In the next few years, I would like to pivot more towards the just dividend paying companies. And this entire portfolio, to be fair, is dividend paying companies. So I'm kind of getting ready for that. But if you are in your 20s, why are you buying, companies like Rio Tinto, for example? You shouldn't be buying Rio Tinto. Rio Tinto is more for basically people who are in retirement, because they do have that, I don't know how many, 7%, 8%, whatever the dividend yield is. There you go, 7%. You don't need those high. Buy the companies that the Nvidias, if you like, the Mastercards, the Broadcoms, and all of these type of companies. So yeah, it will be interesting to have you guys on board. So if you sent me, I think there's 2 more I need to go through today. And if you have sent it to me the last basically 24 hours, apologies, I haven't looked at it, but I will be looking at it inshallah. I've got 2 more more to go through today, and then I will share with that with the community. The good thing about this is I'm just genuinely brutally being honest with you guys, and the reason I need as much detail as I can, as you possibly can, is to kind of give you the type of advice that basically I just talked about, inshallah. Anyway, let's move on to what we came here for, and that is the basically 7 companies. Now, as you can see here, the 5-year EPS growth has to be 15% or more, and also revenue is about 15%. And we're also looking at how much are they growing. So we know where they have been, but how much basically are they growing for the next year, for example. Now, because each company has a different year when it comes to fiscal year, I've used basically the next year, not this year. The one they started, I've left that alone the following year. So some of the companies we're talking about 2027 rather than 2026 because they've already started. Okay, I've taken all the dividends bits out because a lot of these companies do not pay any dividends. In fact, I don't even know if any of them pay dividends. So I've taken that bit out. We're just going to focus on what you see right in front of you. So the first one is Arista Networks. What this one is very interesting. Is one that I have been kind of looking at from outside. I haven't actually gone into more details to see if it's a buy for me or not yet, but it looks like $82 basically dollars per share is where they think the price should be. That's about 20% downside from where we are really. So $102 per share is where it is. It has a wide moat, and look at this, 27% EPS growth over the last 5 years. That's absolutely huge. And then 24% when it comes to revenue. So that 15%, they've demolished that. And then top of that, you got profit margin of 40%, return on equity of 33%, and return on invested capital of 25%, and $3.7 billion of free cash flow. This is a high quality business. This is one that I will definitely be looking at, inshallah, moving forward. Now, the only thing is, look at this now. They are also expected to grow 17% and 18% when it comes to EPS and revenue for the next basically year. So it is really an interesting company. And if you look at the fast graph, for example, as you can see here, the orange line, let me just remove the price here. Okay, the bit I'm interested is the orange line, which is basically the growth of this business. Look at that. Look at how beautiful that looks. And then this basically green section here, or the dotted lines, that is basically for 2026, 2025, 2026, 2027. So it's the expected growth for the next couple of years for this business. And as you can see, they're expecting adjusted operating earnings growth rate of 33%. And the fair value is about 33. That's basically where it has been. Okay, if we look at, I'm just going to focus for the rest of them. I'm only going to focus on the forecast. So we got the estimates. So we're expecting earnings growth of basically 12% for this year. Next year 17%, and then the year after 18%. Based on that, as you can see, if you bought the stock right now, based on the estimates, you'll be losing about 20% per annum, or 43%. If you invested 10,000, you will have right now 5,700. Now, if we use the normal multiple, which is basically what this company has been trading over the last whatever years, which is about that 35%, multiple, 35 multiple, and that 16%, 17% growth, you will be making about 8% per annum, or 21%. So your 10,000 will become, okay, $12,168. Okay, so that's the first one. The next one that we're looking at today is Corpor. This is one that a lot of the brothers on the community on the Discord, by the way, if you haven't joined us on the Discord, click the link on the description and it will take you there. And yeah, a lot of brothers are sharing what they buy weekly, talk about everything to do with the stock market. Yeah, join that if you can. 47.7 billion, wide moat, $49 per share right now. And as you can see here, 18% EPS growth the last 5 years. The same, 16% when it comes to revenue, profit margin 32%, return on equity 18%, return on invested capital 15%, $1.1 billion of free cash flow, and that's really, really good. EPS growth for the next years, they're expecting 12%, in revenue about 9%, and it is undervalued at the moment. It basically, according to Morningstar valuation, is 16% upside from where we are right now. So this is a one that I've seen the brothers on the community have been buying lately. So it'll be interesting to look at in more details, inshallah. Maybe we'll do a full dive on video coming up, inshallah. Again, another one that has been growing the revenue beautifully. And if we add price, let's see what it looks like. So it looks like it's been overvalued for a very long time. And now just looking the estimates here, as you can see here, it looks very much overvalued. So you would be losing a lot of money right now if you're investing in the company as it is. But if we are looking at the normal, by the way, this is basically looking at about 10% when it comes to EPS growth for 2025, 2026, about more or less 10%, and then 12% for the next year. Now, if we just use the normal multiple, which is basically what this company has been, we've got about 11% basically operating earnings growth rate and 35 PE here. So if we look at that, we would be making about 16% or 37, almost 38% total return in the next couple of years. So you'll be making about 13,800 of that 10,000 initial investment. Right, so that's the second one. The third one that we're going to talk about today is CrowdStrike. CrowdStrike is not a new company. It's been around for about 10 plus years now. We've talked about it for a long time, and is one that I've actually used to own it, and I wish I'd never sold it, but I did actually sell when it was probably about 200 or so. And right now it's $514 per share. They've never done any split or anything like that. Very expensive right now. According to this, you'll be losing about 36% downside from where we are. But look at that revenue for the basically an EPS growth for the last 5 years, 35%, 52%, and they're expecting 35% EPS growth next year, 22% when it comes to the revenue side of things. Again, it's really expensive, and also it's not as basically profitable business yet, so we'll see what happens in the next couple of years. But I wouldn't be surprised if it becomes the next couple of years actually very profitable business. But as you can see here, if you invested in the company right now, you'll be losing basically your 10,000 probably will become about $2,417 per share, basically in total. And if we use the normal multiple, okay, so this is based on the estimates. Let's go back here. So this 2025 is already, I think they've done that fiscal year already, 27% growth. And then when it comes to 2026, they've got actually negative. This is interesting. Okay, so let me just go here and check something. I want to see the earnings expectations using Seeking Alpha. Okay, so 2026. Okay, so 2026 fiscal year is already started. So we are using 2027, and that's that for basically 34% and 22%. Right, let's go back here. So that is basically 2027, and then 2028 is about 30. So this is what we're using. This is basically where we are right now. So this year they're expecting to lose money. That's very interesting. And if we use the normal multiple for this company, okay, what you would see is the 155 PE, and that will give you about 26 per and basically total annualized rate of return, which is about 18,300 of your initial investment. So again, very risky. I wouldn't touch it right now, so I'll leave that one alone. Dickers Outdoor Corporation is the next one that we need to look at. As you can see here, 32% when it comes to EPS growth in the last 5 years, 19% when it comes to revenue. When it comes to profitability, very, very good. Free cash flow is really good. EPS about 11% for the next year. They expected it to be. Revenue 8%. Right now, about 13% upside from where we are. $120 per share is where they think the price should be. And then historically, there's another company that has done really, really well. If you bought this stock while it was under this line here, okay, so that's March of 2020. If you bought it around there and sold it around here, okay, you would have made your 10,000 would have become almost 98,000 USD, which is absolutely crazy, or 60%. But of course, this is why you should never buy stocks when they're there. If you bought it there and you've held it up until right now, you would have lost your 10,000 would have become now 4,800. This is why we need to be careful with overvaluation. But it's right now below that orange line, below that blue line, which is the normal PE ratio for this stock. And as you can see here, when we look at the forecast moving forward, normal PE for this company, you would be making about 3%. If you use the normal, that's the estimates based on these estimates that we're using here, 12% and 15% for the next couple of years. Yes, this year they're going to lose some money in 2026, but normal PE for this stock, if we use that, which is about 20 PE, and that 8% when it comes to operating earnings growth rate, you'll be making about 16%. So your 10,000 will become 15,000 USD, which is really good. So this is one of the companies I have in my portfolio already. In the family portfolio is a new addition, and I will continue to hold that one, inshallah. Next one is 80 billion market cap, wide moat, $105 per share. EPS it grew about 42% last 5 years. Revenue 22%. In terms of profitability, one of the best out there. 2 billion of free cash flow right now. They're expecting the earnings to grow about 14%, revenue about 13%, 2% upside from where we are, which is interesting. Another one that historically has done really well, overvalued over quite some time. In 2013 is probably the time you would have bought this company while still undervalued. Other than that, basically it's been overvalued for quite some time. As you can see, that above that orange line, and then it's gone too far. It has come back down again in 2022, I think, when the entire technology sector was down. Then, as you can see, it's gone up again, and right now this is where we are. Okay, now if we just look at the forecast moving forward for this company, by the way, that whole time basically has been it had adjusted operating earnings growth rate of 26% and fair value of basically a normal PE of about 48. Now looking forward to the future, we can see here 2025 about 4% growth, 12%, 13% growth in 2026, about 14 or 15% according to this, and the next 3 years. And if we use that, basically you'll be losing right now about 27% of your money. If you use the normal PE, okay, which is what Mr. Market likes to trade this stock, you would be basically making about 10% per annum, or total annualized rate of return of 27%. So your 10,000 will become 12.7 thousand. Okay, so the next one is that we're looking into the Uplavin, another one that I have talked about very recently. Very interesting business. 116 billion market cap. As you can see here, the 5-year growth rate 84%. The 5-year growth rate for the revenue side of things 36%. Profitability, probably one of the best companies out there. $2.5 billion of free cash flow. They expected the earnings to grow 43%. Revenue about 21%. Right now, basically $307 per share is where they think the price should be. That's downside of about 10% from where we are right now. I think I was looking at early here, and if you click the ratings, you will see this is actually buy and strong buy from quant. So we will be doing it basically a bit more we're just gonna check this one out, inshallah, in the next few days. And finally, let me just go on here and just go over some of the basics for this company. Again, look at that growth. Look at that growth. Absolutely ridiculous. It hasn't been around for quite some time, so which is mad if you think about it. Forecast side of things, if you use normal estimates, 83%, 84% in 2024, 37%, 25% in the next couple of years. If you bought this stock right now, you'll be making about 20% per annum, basically annualized rate of return. So your 10,000 will become 15,747 USD. And if you bought this stock right now as it is, basically without anything, if you use the normal multiples for this stock, let's go back here. Let me see the estimate of what the PE was. The fair value for this was 37. Okay. And 56, wow, that's crazy. So that 56 will give you 40% per annum, or 23,454 USD for basically that 10,000 initial investment. Finally, Lululemon, one that has been basically everyone hates right now. The stock hasn't done much. There's a lot going on. There's a lot of competition. There's problems with the China, and of course the product that they buying their making their products overseas, and the margins being squeezed on, all those sort of things happening with the company. But as you can see, they grew that revenue and EPS nicely over the last years. 24% when it comes to EPS, and revenue about 22%. Profitability really good. $1.3 billion of free cash flow. They're expecting the earnings to grow about 6%, 7%, high single digits, not really too much. 23% upside from where we are. If we go to fast graph, for example, and check this one out, this is the one I'm really concerned about more than any other company. As you can see, it's been overvalued quite some time, and right now we are here, so way below that orange line. And if we basically look at that period of time, was growing about 30% when it comes to earnings growth rates and side of things. If we reduce that for the last 10 years to about 20%, if we reduce that to last 5 years, about 10%. So really decent growth for the last whatever years. And if we look at the forecast, for example, then using their normal PE, and right now if you bought this stock, you'll be making 1%. Basically they're not huge, because this growth here, that 8% in 2026 is actually literally 1%. 2027 is about 8%, 9%, and 2028 they expected 6%. So there's a bit of a decline in the revenue. That's probably one of the reasons, or the EPS if you like. And then if you use the normal multiple where the company has been over the last whatever years, and I don't think we should use that, because this company was growing massively and right now it's not doing the same thing. I would not be buying this stock thinking I'm going to make 47% per annum, or my 10,000 is going to be 27,000 in basically 3 years. That's not going to happen. And the reason I say that is because the growth is no longer there. So you have to be really careful. So you can't just go away and just buy the stock right now thinking I'm going to make 20 something percent. Now you could potentially make about, you know, some good money in the next couple of years, but you are taking also huge risk, because we don't know exactly what is going to happen. There's a lot of ambiguity, uncertainty based around the company. So let's see how that goes first. But really all of them high quality businesses. I will definitely be checking on Arista Networks as well as Copart, and the basic deckers I've already owned. This one I already own. Ab11 is another one that I will definitely be checking. So I'm gonna do basically a whole video on this one soon, inshallah. If you'd like me to go over any of the other companies, also let me know. And finally, from Sharia compliance side of things, always said, you know, I use these standards, and this is where they are, a lot of these companies. Now just be careful, some of these companies are heading towards that 5% business activity. We normally say what we want is a business activity that is above, it has to be less than 5%. Remember that, okay? So this one here is on point. So if it goes down tiny bit, if they start selling stuff that's not Sharia compliant, then we can be in trouble, if you like. But the rest of them should be okay, and some of them actually will score 100% and so on. So yeah, that's the 7 companies I wanted to share with you guys. If you are enjoying this type of content and you like what you see here every single day, of course join us on the Patreon account, where you get access to a lot of things, as well as of course you like the video, subscribe to the channel, share it with your family and friends. My goal here is to share my journey, as well as of course helping the community understand. So I've got a lot more plans inshallah for us in the next few weeks. Let me know if you have any questions, and don't forget to send me your portfolios please, because I genuinely want to help us as much as I can. I've got 2 more to do, like I said, today, and the rest of them inshallah at the beginning of next week. Have a wonderful day. Assalamu Alaikum.